In this audio class, we are going to look at comparative assessment of Basel II and 3 and Solvency II. This is a part of operational risk and integrated risk management FRM part 2. So regulatory framework of Basel II and Solvency II are to be discussed in this audio lecture. Basel II and 3 contains capital rules for banking industry, while Solvency II looks at regulatory framework and quantifiable risk in the insurance industry. Fundamental characteristic of both the banking and insurance industry along with objectives of their respective regulation are discussed in this audio series. Basel 2 and 3 focuses on three risk classes: credit, market and operational. Solvency 2 takes more of a total balance sheet approach, and in insurance industry the system is more principle based as it relates to deriving capital requirement for credit risk. Both in banking and insurance a high degree of transparency is emphasized. Now let's understand the VAR parameter differences, which is the first topic here. So VAR parameter and confidence interval in Basel 2-3 and Solvency 2-3 framework is what we are going to look at. Basel 2 contains regulatory rules for bank and has been recently revised in an attempt to correct potential flaws and weakness. As discussed in my previous audios, this is an improvement set of there is an improvement set of regulations known as Basel 3. Somewhat similar to Basel banking regulation, Solvency 2 framework, which is European Union directive for insurance companies. Both Basel 2, 3, Solvency 2 are modeled on three pillar structure. Pillar, Pillar. The first pillar is quantitative requirement regarding capital requirement and risk requirement. Pillar 2 is qualitative conditions of risk management, terms of supervisory review process and institutional assessment of risk and solvency. So first is qualitative, second is quantitative, including the supervisor review and institutional assessment. Third is requirement of disclosure. So these are the three pillars. While pillars may be the same between all of them, Basel norms give a stronger emphasis on stability of financial system, since systematic is more evident in banking industry. Solvency 2 focuses on individual policy holders, thus insurance regulator focuses more on quantifiable risk of the insurer. Basel 3 require bank to calculate value at risk with a 12-month period of stress assumption. Basel 2 also considers Basel 3 also considers potential mark-to-market losses if there are rating downgrades of counterparties, and contains a leverage ratio assumption in an attempt to reduce leverage in the banking section. Basel 3 also contains more risk measure of institutions that are deemed too big to fail. So with regards to liquidity, there are two ratios in Basel 3 norms. The liquidity coverage ratio, it has 1 month time horizon and require banks to have high quality liquid asset to withstand acute stretch. So this is liquidity coverage ratio, 1 month horizon. Then we have net stable funding ratio, which is a 1 year time horizon and ensure a sustainable maturity structure of asset liabilities by limiting bank reliance on short term funding. So for the 1 year horizon, this ensures sustainable maturity structure by limiting bank reliance on short term funding. If we look at specific risk calibration, Basel 2-3 varies by category of risk. For market risk, VAR 1-tail confidence interval of 99% is required, and it is increased to 99.9% for credit risk as well as for operational risk. So only for market risk we require 99%, and for credit risk and operational risk we require 99.9%. And in operational risk we use advanced measurement approach. Risk calibration with Basel 2-3 is tied to single risk categories, that is each category risk is considered individually. Regarding insurance Solvency 2, there is a confidence interval of 99.5% for the insurance company as a whole. Capital requirement and the Solvency 2 are based on company level risk, and look at how risk exposures are interrelated. Now let's understand risk classification differences, which is the second topic. We need to understand the differences between classes of risk taken into account for Basel 2 and Solvency. Banks are exposed to asset risk due to changes in factors such as liquidity. Liquidity of the banking system is paramount, and the bank can affect the whole banking system, and thus regulatory focus on systematic risk. The insurance industry focuses more on risk of an isolated insurance bankruptcy. The Solvency II framework encompasses all types of risk that an insurance company may face. Insurance industry risk control focuses on ensuring the policyholders are paid. Bank risk controls more focus on market credit and operational risk. Basel III regulation have developed to improve detailed disclosure of a bank's capital basis, risk coverage under strength, leverage ratio, and overall risk management. The current plan is for these regulators to be enforced after 2013. Since the financial crisis of 2007, Basel III has extended the risk control of Basel II with an effort to increase stability of international banking sector. Better disclosure and more transparency in a bank's capital base will be required. Common equity capital core tier 1 will increase from 2% of risk adjusted asset to 4.5% of risk adjusted assets in 2015. You need to remember this, the core tier 1 capital, which is the common equity or equivalent. So by 2015 that should be 4.5%. During this same time period, capital ratio of tier 1 plus 2 will stay at 8%. One of the criticism of Basel II norms is its pro-cyclical tendency. As a result, Basel III contains a counter-cyclical buffer of up to 2.5% which can be enforced if there are too much system-wide risk. As mentioned, Basel II and 3 consider three risk models: market rate, operational. In addition, Basel III emphasizes on liquidity risk. Solvency II comprehensively assesses all quantitatively measurement risk types to which an insurance company is exposed. In insurance sector, solvency capital ratio consists of six type of risk: non-life, life and death, market risk, counterparty risk, operational risk, and intangible. We now move to the next heading here, which is the third heading, which says that solvency and minimum capital requirement under Solvency II. So we need to differentiate between solvency capital requirement and minimum capital requirement and describe the repercussion to an insurance company for breaching SCR, MCR under Solvency II framework. So we are into Solvency II. In insurance industry, Solvency II capital requirement uses two-level approach. Solvency capital requirement. This is the target capital intended to handle expected losses and to ensure a low one-year default probability. It incorporates all risk factors related to underwriting risk. So this is solvency capital requirement. The next is minimum capital requirement. The minimum capital requirement is between 25 to 45% of the SCR, its final threshold, below which supervisory authorities revoke an insurance company's license. So solvency capital requirement and minimum capital requirement. If there is a breach of SCR, the insurance company is given 6 months to bring the capital back to required level. On the other hand, a breach of MCR can result in immediate revocation of insurance company's license. In the banking industry with Basel II, there is only one minimum equity capital ratio requirement or capital coefficient, 8%, which is increased to 10.5% under Basel III. In addition, Basel III directives requirement will increase to cover the quality and quantity of available capital. Within the insurance industry, Solvency II requires MCR to be covered with companies' own funds. The regulator look at difference between assets and liabilities, and values must consist of 50% of the tier 1 item. Funds have to be permanently available to cover losses and must be subordinated to other claims. We now move to the next topic, which is diversification benefits on differences. Now, diversification benefits are related to interrelationship among risk factors which led to large reduction in capital requirement, and this is a kind of a benefit. There are three main level of diversification benefits, and level 2 can be subdivided into two. Level 1 says with specific class of risk with specific line of business. So the main level of diversification benefit, level 1, is with specific class of risk with specific line of business. For level 2A, it is within specific class of risk across specific line of business, and across specific line of risk and within a definite legal entity. So legal entity and line of business are the two differentiating factor in level 2, A and B. Level 3 is across definite class of risk and across legal entities. So within and across are the two keywords, and specific line of business and definite legal entities. So diversification benefits between Basel 2 and 2.3 and Solvency 2.3 framework for capturing the diversification benefit. Basel 2 only consists of level 1 diversification. Basel 2.3. Basel 2.3 calculation for capital requirement is as follows. We have capital upon sum of credit risk weighted asset and into plus 12.5 into the sum of CR of market risk plus CR of operational risk. This is the most famous formula that we are going to look at. I am repeating that for you. On the numerator we have capital. On the denominator we have three terms for market risk, operation risk and credit risk. For the credit risk we have sum of credit risk weighted asset. But for the market risk we have CR of market risk and operation risk, and we multiply that with 12.85. The sum of capital requirement across the risk classes must be greater than or equal to 8%. If we notice this, and we need to notice that this calculation does not consider possible diversification of assets among three classes. Solvency 2, however, consider diversification among risk classes. The basic solvency requirement formula of the basic SCR, and it's like SCR of IJ plus SCR of intangible, and this formula incorporates a correlation metric between various insurance class risk, market health, counterparty, not life. Thus, Solvency 2 consider both level 1 and level 2 diversification. In addition, Solvency 2 is able to consider global diversification benefit, also encompassing level 3 diversification. So in diversification there are three levels. And in Basel we consider only level 1 diversification, which is within a specific class of business and within a specific line of business, and not across the line of business, whereas in the Solvency 2 we consider across line of business activity, and the very famous formula here. Now we have the pillar 1, 2 and 3 differences coming into play, and we need to understand how all of the pillars are different in Basel 2 and 3. So this would be based on the pillar differences. So we'll be comparing Basel with the solvency, and pillar 1 differences, pillar 2 differences and pillar 3 differences. So you can imagine it like a table where we have the criteria, we have the Basel 2, and on right of that we have the Solvency 2. So let's try to delve into this. So the aim here is to understand the difference between Basel and Solvency framework, risk classes and capital requirement, risk measure and calibration, time perspective and valuation. So let's look at differences with respect to pillar 1, and the first thing that we are going to look at is risk classes and capital requirement. So in the risk classes and the capital requirement, Basel 2 has market credit operation risk, Basel 2 expand coverage of Basel 3 expands coverage of liquidity risk, MCR only Basel 2 attempts to provide counter-cyclical buffer by moving toward a two-level approach. Whereas for the same in Solvency 2, we have a more comprehensive approach which consider risks such as underwriting, market, default and operation. It consider SCR and MCR a true two-level approach. Then we have risk measuring and calibration, and we'll look at what is both of them. So both of them have war type risk measure. Capital requirement calculated separately for each class of risk. Here capital requirement is based on company level exposure. We have varying confidence level for each class of risk in Basel 2, and in the solvency we have 99.5 for the entire insurance company. For the capital requirement are intended to cover unexpected losses for each category of risk with a set of probability. Here the goal of capital requirement is to provide 1 year solvency probability. So in this part solvency is typically easier because we have a target confidence interval of 99.5 for entire business, and the goal of the capital requirement is to provide 1 year solvency probability. Now, time perspective, Basel II is retrospective. Recalculation is more frequent, for example, twice a year, even daily in case of internal model for market risk, whereas Solvency 2 is prospective. Recalculation is in principle only once a year. However, solvency is always required throughout the year. Then we have the solvency assessment, and there is a choice between three level of sophistication. Uh, and in solvency we have five level of sophistication. There are restrictions regarding use of internal model to evaluate credit risk in pillar in Basel II, and there is no restriction on internal models in Solvency II. One risk factor based on approach is contained in the standard model, and there are scenario based and risk factor based approach in the standard model. Now, risk aggregation and dependency, only one risk diversification is benefit are acknowledged, whereas in Solvency 2 all are acknowledged. Valuation basis, market based and accounting based, whereas this is purely economic based solvency. So that was the differences between the Basel and the solvency. And we'll continue it again from the second video, which we take it from here. Thank you for watching.